Hello everyone. Today I want to talk about China's trade surplus. In the past year, China's trade surplus has exceeded $1 trillion, which is absolutely a milestone. But we've got to be clear about one thing. Trade surplus is more like a revenue concept, not profit. We can use an extreme example to understand this. Let's suppose that all Chinese exporters sold goods at prices lower than their costs. Then without considering trade friction or tariff barriers and so on, Chinese goods would quickly flood global markets. And China's trade surplus could then balloon to 2 trillion, 3 trillion, or even higher figures. But at that point, no one is actually making money because everyone is selling at prices below cost. And reality isn't far from that hypothetical case. For instance, this chart shows that in major developed countries, the price of physical goods is dropping year after year. What's actually going up is the price of local labor and services, which we will talk about in the future. We know that China's economy over the past few years has fallen into a deflationary spiral, mostly because real estate is the biggest assets for the Chinese middle class. And if property prices decline every year, every month, or even every day, without an end in sight, the middle class obviously would be very cautious to spend money freely, like they used to. This is why in the past few years, budget e-commerce platforms like PDD or its American version Temu have risen so quickly. Actually, this consumption downgrade is happening everywhere in other countries. These developed countries are the primary destinations for Chinese exports. And as their consumption downgrade continues, the prices of physical goods exported from China are also going down. In a sense, China, with its incredible productivity, has been subsidizing consumers in the developed world. And we can also see similar patterns from the financial reports of listed companies in China. Here we get financial reports of Chinese public companies up to the first half of 2025, and you can see the number of listed companies recording losses has increased dramatically over the last few years. The proportion has reached its highest level in over 20 years. And the companies still making a profit are not having an easy time either. You can see the parts of the bars with diagonal lines are the companies that are still profitable, but whose profit margins have thinned compared to 2 years ago. There are a ton of these companies whose profitability has worsened over the last few years. In China, public companies are the most competitive and have the strongest market position. And if even they are not faring well, you can imagine the situation facing other private small to medium businesses. So even though China's trade surplus with major trading partners is rising year by year, it's getting harder and harder for Chinese companies to make money. I asked my friends in export business for their opinions. The general feeling is that for a year or two right after COVID, they're making money hand over fist. It was much easier. After that, it's just been getting worse and worse. 2025 isn't as good as 2024, and 2024 was worse than 2023. A friend of mine in Foshan, who exports lighting, told me that this year his foreign clients are trying harder at haggling. In the past, his American clients were not very sensitive to prices. But starting from the second half of 2024, they started asking a friend to make more and more concessions on price. But even though it's getting tougher for Chinese companies to make money, this constantly ballooning trade surplus is real. Although the People's Bank of China has cancelled the requirement for mandatory settlement of foreign exchange, allowing private companies to keep the dollars and euros they earned, there is still a significant portion of foreign exchange held in the hands of the Chinese government, giving them the confidence and maneuver to exert its influence on the global stage.